Welcome to the WTR Small Cap Spotlight Podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's episode, I have the pleasure of being joined by Rob Ellin, Chairman and CEO of LiveOne Inc., Nasdaq ticker symbol LVO. Also joining is my WTR Equity Research colleague, Eric Goldstein. LiveOne is a Los Angeles-based creator-first music, entertainment, and technology platform delivering premium audio content, podcasts, live events, and original programming to consumers worldwide. At the heart of the company is Slacker Radio, one of the longest-running digital music platforms in the U.S., which powers LiveOne's streaming service, which is available natively on iOS, Android, Roku, Apple TV, Amazon Fire TV, Samsung, Android TV, and embedded directly inside every Tesla vehicle on the road today. LiveOne's subsidiary, PodcastOne, which trades separately under Nasdaq ticker symbol PODC, is a top 10 podcast publisher and sales network with over 200 shows, now generating record revenue and profitability. Rounding out the portfolio are PPV1 for live pay-per-event events, Day One Music Publishing, and Custom Personalization Solutions, which is being refocused around celebrity brands following a restructuring. The company is guiding for fiscal 2027 consolidated revenue of $82 to $90 million and positive adjusted EBITDA across all subsidiaries. So with that having been said, welcome to today's podcast, Rob and Eric.
Thanks, Tim.
Great. Thank you, gentlemen.
Rob, LiveOne has been called many things: a streaming platform, a podcast network, an entertainment company, and even a data business. When you think about what LiveOne truly is today and what it is becoming, how would you define the company's core identity and its single most important competitive advantage? And as a follow-on to that, please, also, can you discuss the total addressable market for the digital service provider, or DSP, and podcasting markets, and why is M&A picking up in the industry again?
Yeah, it's a great question. And, I'll start with we're a DSP, which is, you just said at the end, which is a music platform, subscription platform, right? And there's only a few of us. There's only 10 of us left, right? And when you think about who's left, you just watch iHeart stock go up 10x on two things. One, they announced they're going to put some podcasts in a licensing deal onto Netflix. Okay. And I'll bring that back up shortly on some of the things we're doing. And number two is Sirius Radio made a bid for them, right? So John Malone, who I consider consider the smartest guy in media, is going to put iHeart and Sirius together, right? After you go that, so if you put those two together, you got a $6 billion, $7 billion valuation, and a $25 billion, right, is $30 billion. The next stop is Spotify. Spotify at $122 billion, right? And after Spotify, it goes straight to $1 trillion companies. All that's left is Apple, YouTube, and Amazon, right? So we're in this very unique position that what we think is special, and the reason that Slacker has lasted this long, right, with those massive companies as competitors, is we're the Walmart in the space, we're the lowest price. Number two is we're the most nimble. And number three, we focus all of our energy on B2B deals, right? Like that Tesla deal you were talking about. But those B2B deals, right, are focused on how do we not spend any money marketing, right? We can't spend $86 a sub to acquire subscribers and lose 30% of them, right? That's a very difficult model. And I'm a huge fan of Daniel X. And obviously he spent, $35 billion getting there before he got profitable. Now he's profitable, all right? We have to do it a very different way. And so what I've built all of my companies on, right, historically, is on B2B partnerships.
Okay. Fascinating overview, and very excited to hear more about the company. So I'll turn it over to Eric to ask a few questions.
Hey, thanks, Tim. Thanks, Rob, for joining us today. We really appreciate your time. Obviously, very timely. This morning, first question, you announced a collaboration with AT&T to expand next generation connected car entertainment. Can you talk to us a little bit about that today?
Yeah, I mean, you're watching all of these monster businesses, right? All these Fortune 250, Fortune 500 companies competing and crossing over each other's business. And what's most important is data, right? Everybody's re-woken back up, and this happens in a cycle, right? I started and built Digital Turbine, was my last company, which went through these cycles and then went to a multi-billion-dollar company, went as high as 12 billion, still trades well over $1 billion from pennies, right? When the cycle changes, And all of a sudden they realize they better own some of their own data. So this is a partnership that has taken the better part of 19 months. It took 27 meetings, right? That's minimum. I may be discounting if my team may tell me I'm off, but it took a lot of work to get there. And what it is it gives us an opportunity of three things. Number one is when you go into your car now, anywhere where there are the 65 to 70 million cars that are powered by AT&T's connectivity, right? You will immediately see a LiveOne logo, and you'll immediately be able to go to our music app. Number two is they're going to help us market together with Cisco, right? We're going to package together to use music, very much like we did with Tesla, to drive subscribers. Those subscribers will be freemium, they'll be free, they'll be our middle tier, and they'll be the high-end tier, right? And hopefully out of 70 million people, if we can drive a small percentage. I think one of the analysts said if a half of 1% comes, right, the stock should be 14%, $14 or higher, right? And maybe this is better, right? There's no one better to sign partnerships for a music subscription platform or for podcast than it is on a carrier. And the reason for that is most of the listening and most of the behavior is going to be done on your phone.
Makes perfect sense. So let's take a look at just the structure of your company. When we look at your business lines, we see you have Slacker Radio, PodcastOne, and you have a few other smaller businesses. You spun off a minority stake in PodcastOne a few years ago. Can you maybe run us through the reasons for that? Does that structure still make sense to you today? And then can you give us an update on where your balance sheet stands, just your debt and cash positions?
Sure. A lot of questions at once, but I'll try to give you each one of them. So let me start with why we spun out PodcastOne. Number one is we took in an $8 million piece of debt that was convertible into equity, right, at $100 million market cap, right? We bought the company in 2020, right in the beginning of COVID, from one of the great geniuses in music, Norm Patitz, who built Westwood One. And that's why since he passed away, our branding is everything is one in honor of him and in honor of his brilliance as well as his passing, right? So we spun it out for that, but we also spun it out because it's the only independent podcasting network that trades on a major exchange in the world. All right. Puts us in a very strong position at the right time as the market starts to correct itself for media. We'll have a very good opportunity to roll up this space and continue to add multiple acquisitions in the podcast space. Okay. Regarding the balance sheet, all right, I think was the second one. We have just taken in 5 months ago. We took in $10 million from my partners at Lucid, David Rosenberg and John Lippman, exact same partners who did my deal at Digital Turbine. They did the first at 4, they did the second at 2, and it hit a high of 106, and their warrants ended up being worth fortunes of money. All right. So David called me and said, listen, we can do a firm commitment for $10 million and let's get done. I said, okay, the market's really rough out there for media. So we raised $10 million, but not only do we raise that, we've now also gotten our balance sheet where $15 million of our major partners, our music labels, our music publishers, for the first time since I bought the company, have become long-term partners. Okay. And with that, they converted $15 million of payables, royalties, past and going forward at $7.50 a share. Okay. And that's when the stock was trading at 5. All right. So it was great for the balance sheet. We'll have positive equity for the first time ever. And in the last call, we mentioned that the company is now positioned to really push the auditors to get rid of the going concern. And with positive equity, we're really excited about that. When Digital Turbine got rid of their going concern, the stock went up by $600 million in value in 7 days. So I think it's going to be a major coup for us, right? And with all that, we've been able to maintain our $250 million NOL, right, which doesn't get valued at all, which no one even writes about it. But that NOL will give us the ability, as we talk towards the end of the year, and start moving into GAAP earnings.
That's great. That's great. Thanks, Rob. So let's take a look at your deal with Tesla. So you have 1.1 million free ad-supported subscribers inside Tesla vehicles today, with a daily engagement exceeding 59 minutes per user, which is pretty amazing. So you've just launched an expanded AI-driven marketing campaign. Can you walk us through the conversion playbook? investors would want to understand the math here. If you can achieve a 10 to 15% paid conversion rate on those 1.1 million users today, what does the annualized revenue impact look like on your blended ARPU? Also, can you give
Well,
investors an
I think
update?
it's a, yeah, I think there's a couple of things. Sorry about that. I think there's a couple of things you get out of that Tesla, right? Opportunity now, right? Now, as we revisit it and step on the gas, shockingly, we were able to convert over 50% of every, actually about 63% of every Tesla car, right? We were able to convert into either free or paid subscribers, right? There's only 2 million of them. It's a pretty staggering number. And if we could do that at AT&T or any of our other partnerships, we just announced Samsung, LG, Vizio, which is owned by Walmart. If God willing, we sign, 10%, let alone 60%, you can only imagine what the revenue is going to be. But now's the time for us. Now that we've secured these people and they're using it 59 minutes, it means they always love the service. The fact that they love the service is a telltale sign that we just got to speak to them and get to them directly and get to them in a unique way. Previously, in our old deal with Tesla, we only had a VIN number. We knew your habitual behavior and what music you listen to. We could change your music. We couldn't really talk to you directly or know who you are. And we didn't have your credit cards. We didn't have your information. Now we have all the information who you are. Now's the opportunity for us to start converting. So we are using some brilliant AI technologies that are finding Tesla users. They're finding where the thought leaders are in Tesla. They're finding the thought leaders who talk about music inside of Tesla cars, right? As well as we are using our 216 or 18 podcasters, everyone from Adam Carolla to Lady Gang to Baby Mama to Dr. Phil. We're using them to also drive those subscribers when they're listening to our podcast to convert to paid subscription, right? And we have the ability to be nimble and offer them unique deals for them to do it, okay? If 10 or 15% convert, we're going to pick up 150 or 200,000 subscribers, an average of like $6 a month, right? And some will be the mid tier, some will be the high tier, like every other music subscription, right? But we are the lowest price by far. If we pick up an average of $6, we pick up $1.2 million a month. We pick up $12 million. If we do that for 3 years, we picked up 40 million in revenues, and we're right back at 120, 130 million in revenues without any of the new partnerships. So we're really excited about it. We've now had 2 straight months of growth, right? That's the first time in a year, right? Off those subscriptions. And now we're going to really step on the gas and really spend the time to convert these people and convert as many as we can.
Okay, fantastic. So let's take a look at PodcastOne. So you have executed a pretty remarkable turnaround here. So just a couple of weeks ago, I believe PodcastOne raised their fiscal 27 guidance to 68 to 75 million in revenue and 7 to 10 million in EBITDA. And separately, you completed a $7 million warrant exercise, repaid all your debt, your junior debt, and now you hold the largest cash position in the company's history. So what's driving the guidance raise? Is it advertising momentum, B2B platforms, AI licensing, or all three? And then one angle that caught our attention from a recent presentation you made, you noted that video now represents about 30% of podcast revenue and that you're targeting 50% with TV adaptation deals already underway. So can you walk us through the video monetization model as well?
Okay, a lot of questions. So let me start with, so you understand. We bought PodcastOne doing 17 million in revenues, losing 5. We finished this year at between 60 and 62 million, right? We're a March 31st year end, 60 and 62 and 6 million plus in EBITDA. So that's an $11 million swing in the 5-year period since we owned it, right? And a 4x on the revenues, 3.5x on the revenues, right? So going into this year, we said we're going to do 68 to 75 million. So another great growth year, right? And I just raised the guidance again to $7 to $10 million of EBITDA. It's becoming a very serious business. Why is it becoming serious? Number one is our podcast is making more money because it's not just audio. There is now a movement into video that is so big and so unique, right? You watched it with YouTube. YouTube came out and said, I believe it said the industry is now 9 billion, going to 25 billion. So massive growth between now and 2030. And YouTube says they have record video growth for the 4th straight year in a row. Okay, say. Number two is You watch iHeart stock go up 10x on an announcement. They put a couple of their podcasts and licensing deals onto Netflix. Okay. I'm going to be talking about this a lot. I've only brought it up in the last conference call for the first time, but I've been bringing it up internally because I'm expecting this to happen for a long time, which is why would every streaming platform not buy a music platform? First of all, they got to compete with Amazon, YouTube, and Apple, right? All three of those have both audio and video, right? So if you're going to have it, you better be competing at right in the center of the ring with them because they're now a streaming platform as well, right? Amazon Prime eats into your grid and comes right after, Paramount and Peacock and HBO and so on. So why would they not buy an audio? They have such difficulties raising their ARPUs $1 every 2 years, right? So now what everyone's waking up and realizing is all these streaming platforms are either television networks, cable networks, or they're cable and satellite themselves, right? They're putting everything on. They're putting every kind of channel, every kind of content on. So it's becoming very important to have talking heads, right? I humbly believe that every one of these streaming platforms should buy an audio network because the beauty of an audio network, when you add $1 price onto Netflix every 2 years, right? You got to make another $2 billion worth of movies and television that may or may not work. Music always works. And they're not paying for it. Now you pay a big percentage to the record labels and the publishers, but you don't have to curate and create that content. It's a syndication business, right? So imagine if they bought, a music streaming platform, which is what I thought was going to happen to iHeart, right? Figured the only reason I'm long the stock is they're going to get bought by Netflix, right? It makes so much sense. Netflix could raise the prices $5 tomorrow morning. Okay. If they buy us, they could raise them tomorrow morning. They already have 350 or 400,000 subscribers. Imagine they just add music and they change the price by $5. What would happen to Netflix stock? Okay? Sure. Skyrocket. Okay. So ARPUs are critical to any subscription business. So for us, we're right in the sweet spot. We're one of 10 that's left. There's really not another one in the US. Everyone's getting bought. TuneIn just got bought for $170 million. They don't even have music licenses, right? Sirius is getting bought by iHeart, right? Tidal got bought by Square a couple of years ago for $400 million. I did more revenues than any one of those, right? Than any one of these small ones, right? Same thing, Napster got bought for $230 million. There won't be any audio platforms left except for us. That's it, right? And we're the only ones that can white label and the only ones that are willing to, if Tesla or any one of the retailers or any one of the streaming partners wants to brand it as their own. We'd love to have it powered by LiveOne, just like Intel inside, but we're totally good if you want to white label it. And I don't think anybody else is willing or able to change their brands or give up that or have the nimbleness that we're going to have.
That makes sense. So let's take a look at your use of AI here for a second. So PodcastOne has launched PodcastOne AI. So you're targeting the AI training data market with over 250,000 hours of premium video and audio content now being prepared for licensing to hyperscalers. And the company expects to begin generating licensing revenue this quarter. So at a recent investor conference last month, you put in explicit dollar value on that content library of between 500 million and 750 million, which is obviously a big number relative to the size of your company today, the market cap of your company. So can you walk us through how you arrived at that valuation?
Yeah, I didn't give the market cap the value what they're going to be. I'm just giving you what's out there clearly, which is that these practice models are going to get more and more desperate, right? They are so hungry for data, right? If you're going to train a car to drive or you're going to train a robot, they're going to learn human behavior, crying, laughing, smiling, all the different things, right? And what you're seeing is, and I've been saying this for about 6 months now, you're going to see all the AAA content ripped down. If you go into the AI today and I wanted to change your face or my face to James Bond or to Mickey Mouse, 10 weeks ago, you could have done that. That's over. In fact, you won't even find anything that looks even close to them anymore because the lawsuits are starting, just like Napster, just like movies years ago. It took years for this to unwind and to negotiate the deals. So literally CNN just sued I forget which one of the AI companies, one of the big AI companies. They just sued them last week, came on CNBC and suing them. This is going to come fast and furious. And when that content is ripped down and they don't have that, right, they're going to lose a tremendous amount of data. There's very few companies on earth that have 250,000 hours of data. They don't need 1 hour. They don't need 2 hours. They don't need one person crying at 2. They need thousands of hours, tens of thousands of hours to fill those pipes. And they're all in non-exclusive deals. So I think you're going to see the monetization happen imminently. Okay. I think you're going to see monetization of codes. I have 24 years of building apps and so on. Those codes are now called tokens, right? Okay. You're going to see, I've only said video content of 250,000 hours. Imagine how much audio content I have. We have a ticker, like literally in the office, adding this all up, because it's going to take a month to gather all of it. And this is all just hitting high cylinder. We have to figure out it is, but you can be sure we have hundreds and hundreds of thousands more of audio content than video content, because most of the podcasters did not generate video content until the last 5 years. Okay. Very few that did. And we have, amazing talent like Dr. Phil and Adam Carolla who own their own content. And owning your own content, we already have our rev shares. We already have our partnerships. It's going to be very hard for anyone else to find licensed content at this mass.
Okay, really amazing. Thank you. So let's talk about your B2B partnerships. So LiveOne has disclosed a 3-year Amazon partnership, a multi-year agreement with Fortune 250 streaming network valued at over 26 million, and a growing ecosystem that includes Amazon, Apple, Spotify, YouTube, Paramount Global, Pluto TV, Telly, LG, Samsung, and Vizio. And the Slacker B2B pipeline stands at 70 plus potential partners across 5 verticals. So give us a framework for how these deals are structured, and what do you offer a distribution partner that Spotify or Apple Music doesn't today?
Well, they can't, right? So they can't white label. They can't drop their prices and be nimble. And they don't have the ability for their tech team to sit and stand up and handle the amount that is being asked for from these B2B partners, right? So they're just too big, right? And they don't need it the way we do, right? So we do it nonstop. This is what we do. And if you remember in Digital Turbine, I signed 58 carriers and probably 10 hardware companies. This time, not only do I have mobile companies, because all my business is a mobile centric. It's a reason they go to $1 billion. It's because I focus on mobiles where there's 8 billion people and there's 8 billion phones, right? So what's happening now is that the B2B partnerships are all of a sudden, the cycle is changing. Everybody is focused on data. The word AI is a big word for a lot of things, but the reality is it's data, right? And how do they get their hands on the data? It's starting with their own customer base. If they're talking to their own customers on a regular basis, it's game changing. So we have now partnered with, just in the last 4 weeks, Samsung TVs, LG, Vizio, which is a beautiful partnership because Vizio, the CEO just talked about Vizio and Sam's Club coming together, right? Without saying the word Amazon Prime to compete with Amazon, right? There's going to be a unique opportunity right now that all these companies, Fortune 250 and 500 companies, are literally infringing on each other's businesses. And the number one spot they're going to be looking at is owning their own data, right? The carriers, today's announcement with AT&T, the carriers used to control their own home screen. Now it's controlled by Android and Apple, all right? That's a scary proposition, all right? So this is a great opportunity for us to either distribute, right, through all of these sizable companies with 10 million to 3 billion eyeballs, to have them as an investor, strategic investor, and come in, or to buy the company.
Okay, fascinating. So let's take a look at some of the cost reductions the company's been going through. So you have reduced your headcount from approximately 350 employees to under 90, while maintaining your revenue, actually growing your revenue, and cutting your quarterly operating expenses by more than 50% year over year, which is pretty dramatic to say the least. So all your subsidiaries are now expected to achieve positive adjusted EBITDA in fiscal 27. Can you be specific about where you're using AI to replace human labor? Is it content curation, ad trafficking, customer service, etc.? And is there a floor below which your headcount reduction becomes a risk to trying to grow the business?
Yeah, actually, it's not a risk. It's a reward. I mean, it's always hard to do, and some of this was going to happen. Attrition was going to happen anyway. We did 5 acquisitions. We got hit with COVID, right? So it was very difficult to run a business, right, where people are no longer coming into offices, right? Very different animal, all right? So what we did is we studied it hard, and we have utilized AI in a very unique way. Starting with, we used to have 100 DJs and VJs and hosts hosting these channels, right? I could stand the music channel if you wanted for your wife and yourself. You want your anniversary night, and I had your habitual behavior of your music, right? I'd be able to stand up channels for you and name American in the Goldstein name, right? And here's your happy anniversary, and I could put 10 channels together in 30 seconds, and I literally could have one person instead of one person per channel doing that. So that was a big cost savings. Okay. Number two is it just amazing what you can build now. Apps that you can build, software you can build, the things that AI can do for you are dramatic cost savings for us across the board. And then our marketing side, right? Our PR, our IR, right? You don't need the staffs anymore, right? You can write these PRs so intelligently with one person overseeing them and making sure that you touch them up and make sure they're right. Okay, we had to do this AT&T announcement. We got the call at 1:00 in the morning last night. Said AT&T is coming out with theirs. They're putting it out at 9:58, and we got to have it out at 10. Right? Normally that would be a fire drill beyond anyone's belief. Right? We put that together in less than 10 minutes. Got it over to them. Got their approval. Right? Cisco took a little bit longer. Once we had everyone's approval, we were able to move forward. So there's just great cost savings. I would say we're probably at the tail end of that now, in that you're going to start to see us hire again, all right? And it's not going to be a lot of people. So we're gonna build, game changers. So where are the game changers going to be? I publicly said we're going to announce a new president of the company, which I do with all my companies, who has built and sold a public company for $1 billion or better, right? Built and exited, right? Whether in the market or sold it, right? So that's happening very shortly. Number two is you're going to see us hire heads of each of those verticals. If we're going to do these massive B2B deals, right, we're not exclusive to them. They're exclusive to us. We have a huge opportunity to expand upon those. And we can go as deep and as wide as social media, cable, satellite, streaming networks, audio, right? All the car companies like Tesla, right? And expand from there. Hotels, airlines, membership programs. So we see a telltale sign. And if you guys didn't know, I owned Kazaa years ago and had one of the greatest runs in the stock. Like literally went from 40 million to 600 million in no time. And we were able to use that to buy a lot of companies. But I also got a great learning curve, which is it's an unaffordable model to buy subscribers. You just can't win. So we're going to stick to those B2B deals and stick to those partnerships and really position ourselves that we're going to leverage our great content in return for this great distribution. And we're going to rev share it and partner with them as deep and as hard as we can with all those industries. And you're going to see heads of each of those verticals being hired pretty imminently.
Okay, makes sense. It's very impressive. So let's just take a look at the structure of the company again, which we had touched on a little bit earlier. So LiveOne owns approximately 70% of PodcastOne. PodcastOne has 27 million shares outstanding. So at a recent price of $5, that stake was worth between somewhere in the neighborhood of $90 to $100 million, which is just shy of LiveOne's market capitalization, which is around $120 million.
No, LiveOne's way less than that. It's kind of crazy. Our ownership is about 20 million shares. That 20 million shares worth 100 million. LiveOne today is trading in the 6 range on 14 million shares. It's trading at 84 million. So we're trading below the ownership in our subsidiary, right? Doesn't happen often, but as you know, it's a very inefficient market. And, we're just coming out of death and destruction of media. And you're watching media stocks that have literally just slowly dropped for 7 straight years. My friends at Stars, Jeff Hirsch, his stock, so proud of him. His stock is up from 6 to 27, right? Lionsgate has gone from literally from $7 to $15. iHeart's gone from 60 cents to $6, to as high as $8. Now it's, I think, about 4.5, 5, right? So media is finally getting some attention, and people are waking up and realizing, what is media? Media is data. Data is critical to AI, right? Media is going to have a huge, huge, footprint and a huge amount of new revenue streams that drives out of it. And I think everybody's just waking up to that. And there's always there's a line in the media business that is, content is king and distribution is King Kong. There's so much distribution right now that content is king and King Kong. If you have AAA content, you have an invaluable asset that is going to get paid in a real way. And I humbly believe Talking Heads is the one missing ingredient from every streaming platform. They're paying the Jerry Seinfelds and Dave Chappelle's $20 million to do one show. Why would you not want to have a true show on your platform with the great thought leaders, right? And those great thought leaders have massive audiences, and you could take the audiences with you.
Okay, so clearly, just as you articulated, the market is not ascribing much value at all to the LiveOne assets outside of PodcastOne. And then you mentioned earlier there's been some speculation about a SiriusXM iHeart combination. How would that change the competitive landscape, and does it create any strategic opportunities for you in advertising or licensing and so on?
I mean, I think, listen, less competitors are out there is always better, right? I'm a huge fan of iHearts. I'm a huge fan of Bob Pittman and John Sykes and what they've done. They've built just an amazing asset, right, with great content. I'm a huge fan that of what Sirius built. I was a large shareholder in it and a partner with Mel Karmazin when he originally took over control of it. So I'm a big fan of it. But it just opens the floodgates again for us as the small, nimble player to be able to do these B2B deals, as opposed to go try to spend, $100 million marketing, right? We got 1 million Tesla subscribers, right? It costs to get those free subscribers about $86. Okay. Well, 86 times a million is $86 million. We don't spend a dime. And we're in Tesla cars in perpetuity. Every single car will have LiveOne one button on it. We have to convert more. We got to press to convert them. But if we keep doing what we're doing, we're gonna have a nice footprint in this industry, and we're either gonna get bought. All right. I just hired Craig Christensen at the CFO role. Right. Big, jump for us. He did 24 acquisitions in his last company and trades at a $600 million market cap. Right. We're sitting here trading at 80. All right. We'd be thrilled to get to 600 and be working back towards where we were. And we traded, between 400 and 800 million for almost 6 years before COVID. So we're really excited about where the business is going. We're going to keep upgrading. As you know, we have one of the most prolific boards in media in the world. Right. It's like the who's who in media. Everyone from Steve Bornstein, who built ESPN and the NFL networks, Kenny Solomon built the Tennis Channel, very similar models to what we did. Patrick Waxberg was co-chairman of Lionsgate when the stock went from 6 to 48. So we have some really special people here, and we have a beautiful flywheel, right? It's all about talent first, driving traffic. The more traffic they drive, the more the flywheel goes around and the more revenues we drive. So we've talked about audio. We've talked about Slacker's audio. We've talked about podcasting. We have a pay-per-view technology that we built in-house. We have live streaming we built in-house. We did over 4,000 artists, from Justin Bieber to Bruce Springsteen to Metallica, all performed on our platform live. We've had over 5 billion engagements. So we have world-class technology, world-class board, right, and world-class content. I've never had all of those pieces in the same time. I've always had most of the pieces, but I've never had all of them at the same time. And I've been pretty fortunate, with a lot of hard work and go through a lot of trials and tribulations, including almost going out of business in Digital Turbine in 2008. We were an hour away from going broke, right? The stock dropped $500 million in valuation as I was skiing down the mountain in Aspen. And I apologize if you already heard this story. I'm not that good a skier, but I'm good enough to get down the mountain without losing 500 million, right? It was disastrous. We fought through. We had debt holders. We battled through it. We turned around. And what I tell you is, and I steal this from Michael Jordan, really. I've always said, and this really comes back to me from my staff. They said, "How do you do it?" And I said, "How do I do what?" They said, "You don't stop working." I love what we do. I absolutely love what we do. So we win because we outwork everybody else, right? The the carrier deal took a year and a half. The retailer took 2 years, 2 years and 6 months, and still going, right? Contracts are signed, right? But the real launch is happening. I'm really proud of my team, and they're really a special group of people. And we're just going to fight through it until we get this thing to a unicorn.
So, Rob, I just want to say thank you very much for joining us today. You've laid out a pretty compelling story. You seem to have businesses that are incredibly well positioned for things that are going on in the marketplace today. And it seems like as you continue to execute, I'm sure that the market will start to pay more attention and start to value your stock more appropriately. Tim, I just want to turn it back to you.
Thanks, Eric and Rob. Thanks for joining us today. A really fascinating conversation. It's not lost on me that you're the primary owner of PodcastOne and you're on our podcast. So a bit of an irony there, but it does feel like you have wind in your sails. So congratulations, and hope the trajectory continues.
Great. Let me just give you one more
Please.
little tidbit that I think is important, which is that we bought back $6 million worth of stock in LiveOne. We bought back 2.3 million shares of PodcastOne. And I publicly just announced we're imminently going to start buying back more LiveOne stock. Okay. And are continue to buy Live PodcastOne stock every day. So we consider all options in this. But the one thing we know is we're so undervalued right now. The industry is trading at 3.7 times revenues. We're trading at 80% of revenues. Right. It doesn't make any sense. Right. It's time for us to go back into the market and buy back stock. And buyback is a very substantial piece right now.
Great. Well, thank you for sharing that data point with us as well, and have a great afternoon.
Thank you, guys. Appreciate the time.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.